Good morning, everyone, and welcome. My name is John Franklin. I'm the State Director for Pennsylvania, Delaware, and Southern New Jersey, and I want to welcome you all this morning. First of all, acknowledge the function. Jordan Claffey, who is in charge of Next Gen, has also been named Program Co-Chair for the upcoming deal making, which will be in October, so I wanted to acknowledge Jordan this morning. Liza Rice and Matt Ryan were instrumental in putting this together, so I think a nice round of applause is certainly appropriate for them. I want to thank Villanova University and ICSC for certainly being available to host this morning, and beautiful facility. It's certainly nice being here. And many of you haven't been in a classroom in a long time, and if you have been recently, that's good too. One of the announcements that I wanted to make before we get our program going is that next week, or actually in 2 weeks, is our University of Shopping Centers, which will be held at the University of Pennsylvania, as it has been for the last 7 years. One of the interesting things that we're doing this year is that on Monday, if you are a student or if you have a student, you may attend those classes for free. So if you do have a child in school who's matriculated any university, any school, somebody asked me the other day, if I go to high school, can I go? And I said, why not? You're a student. I mean, if you have your student card from Villanova, from wherever you went to school, please show it. I'm sure we'll take you as well. But there wasn't any real distinction about that. So to that extent, I would encourage you to please take advantage of that. That's Monday. I believe it's the 8th. If you go online, you'll see that you can sign up for a morning and an afternoon class. So plenty of very good classes. So we're trying to encourage, as part of this Next Generation program, to kind of get our kids, if you will, into the drill as well. So it's a very good program that we're running as well. Before I turn it over, somebody asked me if how I knew Mr. Ullman, and did I want to make any remarks about our speaker? And I only have one thing I'm going to say, and that is Mr. Ullman has been our very distinguished graduate of Harvard College. I just wanted to mention one quick anecdote, particularly in light of the economic circumstances. And the other day I was coming out of Goldman Sachs, and there were two young people, obviously recent graduates, who were coming out very ebullient, very elated, jumped into a taxi cab, and as they were bragging about their interview and how wonderful things were going, cab driver turns around and says, "Where'd you kids go to college?" The young man said, "We're Harvard class of '08. He turns around and says, "I'm Joe, class of '58. So now that we've got it started, I'm going to turn it over to Jessica from Villanova, and thank you all very much.
I just wanted to give a quick welcome, thank everybody for coming out, tell you a little bit about the DiLella Center for Real Estate. We are in our 4th academic year. Currently have a minor at the undergraduate level, but are proud to announce that we were just approved to begin offering a major in the fall semester. So we'll be graduating our first class of real estate majors in 2013. We also offer an MBA concentration in real estate, and just are graduating our first students with that this semester. It's exciting to be with the program. It's growing so quickly, and it's really important to us and to the program to do events like this, to connect with industry professionals and really engage with the students and the education offered here. I do have, if anybody's interested when the presentation's over, a handout with a couple of upcoming events that we're offering here at the DiLella Center. Or if you'd like to get more involved, just grab me and I'm sure I can find something for you to do. Thank you, and I'll turn it over to Lauren. There she is. Thanks.
Good morning, and welcome to our inaugural CEO breakfast presented by Next Generation. I'm honored to introduce Mr. Leo Ullman, for I've been privileged to work with this man for the past 5 years. In order to gain insight into the man seated in front of me, I must provide a brief history. Leo was born into a Jewish family in Amsterdam. During World War II, young Leo was separated from his parents and hidden from the Nazis by a Dutch policeman and his wife. After the war, he was reunited with his parents and moved to the United States, where his family settled in Port Washington, New York. After graduating from Harvard, in just 3.5 years, Leo went on to simultaneously complete his law degree and MBA from Columbia University. After 6 months of active and 5.5 years of Reserve U.S. Marine Corps duty, he went on in the early 70s to run his own law firm and began representing Dutch and Belgian investors in the U.S. During this period, Leo wrote for several publications, lectured, and served as an adjunct professor of international business at the NYU Graduate School of Business. In fact, Leo continues to make use of his remarkable writing skills by contributing real estate articles to a Dutch newspaper. Leo's involvement in real estate eventually took over his professional life. In 1998, he purchased Cedar Income Fund, a small-cap real estate company that traded on NASDAQ with the aim of growing its portfolio. 3 years later, he gave up his law career to devote his time to real estate investment and management. At its purchase, the Cedar Income Fund had $30.5 million in property value in its portfolio. 5 years later, Leo and partners grew the portfolio exponentially. The company was renamed Cedar Shopping Centers, Inc. and undertook an IPO in October of 2003 using the letter CDR on the New York Stock Exchange. As of 2011, Cedar Shopping Centers owns approximately 132 shopping centers with more than 15.9 million square feet of gross leasable area. Cedar continues to grow its portfolio through acquisitions and joint ventures, such as our newest arrangement with RioCan, as well as redevelopment and repositioning of its wholly owned properties. With all of his success in education, the law, and real estate, Leo still finds time to pursue his passion for athletics. At 53, he and 3 of his children ran the New York City Marathon. This began his pursuit of running, biking, and swimming. To date, he completed 10 marathons, multiple half marathons, triathlons, and 3 Ironman competitions. In 1997, he biked 3,000 miles across America, and in 2000, swam across the Long Island Sound. Today, Leo and his wife continue to reside in Port Washington, New York. They've been married for over 50 years and are parents to 4 children and have 7 grandchildren. As one can see, Mr. Leo Ullman is not solely defined by his excellence in business, but his collective life is what truly makes him a successful man. Without further ado, and a warm welcome, I introduce to you my Chief Executive Officer, Mr. Leo S. Ullman.
Thank you all very much for being here. I learned a lot about real estate this past week. I went to visit some real estate owner, and he had a sign on his desk. And it was very simple, and it really breaks down real estate into its essentials, which I had never really fully realized. It said, "Make leases, collect rents." I'm going to talk a little bit about our portfolio, and I'd encourage any questions that you might have, and I'd like to try to answer them. Historically, we have decided, based on some properties that we acquired long before we REITed, to focus on a conservative, risk-averse, defensive kind of portfolio. And in this connection, we acquired a lot of community shopping centers anchored by supermarkets. We felt that people always had to eat, and supermarkets would be a very good base for our portfolio. As a result of that, we acquired a bunch of properties, initially in Pennsylvania. We now have more than 50 properties in Pennsylvania, very much focused initially, also because of historic reasons, in the greater Harrisburg area, which we liked because it was stable. Unemployment was relatively minor because of the government functions and all the distribution buildings. We liked the fact that there were severe barriers of entry, and it was a relatively low-growth model with pockets of high demographics, such as Hershey and Carlisle and Camp Hill and so forth. We developed a portfolio that's 75% anchored by either supermarkets and or drugstores, and about 50% of our total revenues are derived from what we would call necessities retailing, with almost 40% of our total revenues attributable to supermarkets. We are very much tied into, or have been historically, to Giant Stores of Carlisle, PA, and they are a dominant operator in their area of middle to northeastern Pennsylvania. We like them a lot. They're very good operators, and it's been a hallmark of our portfolio. The challenges we have faced based on starting in that portfolio have been that the perceptions of the public markets are very much different from the precepts that we've been used to with respect to the private markets and with respect to real estate as such. There is a substantial difference between being a real estate person and being a real estate person in the public markets. The public markets define for you requirements and metrics that are often diametrically opposed to what would make sense as a real estate matter. And this has been one of the most difficult lessons for us, and it's been made more clear during recent months. Supermarkets, for example, were the darlings 2 years ago. Everybody was looking for supermarket-anchored properties. All of a sudden, supermarkets are not such darlings anymore. People think that the supermarkets haven't performed as well as they did a couple of years ago. There are severe challenges. You've seen the A&P go under. Super Value is in a lot of difficulty, and they own a lot of chains. And you've seen chains like Shaw's, as a result, leave Connecticut completely, though they were the dominant player a few years ago. The Walmart factor is very important, needless to say, in the supermarket business. And so the perceptions have been much more toward a preference for big boxes and co-anchors rather than just a supermarket-anchored property. The perception also has been, for our kind of properties, that it's not that great to be in the slow growth markets. We have wonderful supermarket-anchored properties with the dominant supermarket in most of our areas. And you take an area like McConnellsburg or Mechanicsburg or small towns in Pennsylvania where you have the only grocer in town and it's doing $600, $700 a foot. That no longer is that interesting to investors because these markets are perceived to be slow growth markets. And Pennsylvania gets tainted by what's happening in Harrisburg, even though Harrisburg is a 47,000 person city. Its bankruptcy and Pennsylvania, or its insolvency, let's call it, and Pennsylvania's difficulties with financing pension obligations and so forth, and health care, all of that plays a big role with investment bankers and investors generally, certainly institutional investors, in being very nervous about much of the secondary and tertiary products in Pennsylvania. There are other challenges, I think, to our business that we have to deal with. One is, of course, the internet. Explosive growth is continuing, and you've seen, obviously, what's happened to the Blockbusters of this world, and maybe, just maybe, it'll happen in other sectors. Certainly, we've seen it with the bookstores. Borders is gone, and or at least went into chapter, closing a lot of its stores. Probably the only ones that are making money are in the airports. Books are no longer a readily saleable commodity when you have the e-books. You've seen it with potentially, I think, with the electronic stores. The explosive growth of sales of electronic products on the internet, I think, is something that we have to watch very carefully. Eventually, gas as fuel may be something that we ought to be concerned about in terms of your convenience products. Online banking has caused a lot of banks to close branches, even though historically branches was the way to generate cheap deposits and make a profitable bank, which has an impact, of course, on out parcels and so forth. So going forward, what does the market look for? The market is looking for better demographics. I think the market is looking for the kind of products that the Federal REIT has, or that Acadia has been talking about, or that Equity One is moving towards. They're looking for more people in that 3-mile radius, and they're looking for greater family income. The second thing they're looking for, which again is somewhat contrary to basic real estate principles, is that they are looking for low leverage. Historically, the way you make money and the way that wealth was created in this country was to finance real estate products to 75–80% because the cash flow was predictable. And for our kind of product, where we have these supermarket anchors and very little ancillary retail, and we have the dominant grocer in these various markets, our cash flow is predictable to the nickel. We know what's going to come out there, and that's financeable if we wanted to 75–80% with the banks, if we wish to, and that leverage should boost your earnings, and you would think that that would be a good thing to do. Well, in fact, the market has valued, in addition to better demographics, the market has valued low leverage. If you look at the REITs out there that are performing well, it's those with low leverage. And therefore, when we have our joint venture properties, for example, with RioCan, which Lauren mentioned, the mantra is to finance not more than 55% or so of the purchase price. The REITs that are performing best have less than 50% debt to total cap. That's a very low measure for real estate, and you'd really like to benefit from the cheap borrowing costs and the beauty of non-recourse debt. But again, the market does not favor that. I think you will also see that the market is starting to favor bigger properties. They like the redevelopment story, though they don't want to fund construction, and they don't want you to fund construction. But the market likes the bigger properties in general. They like the big boxes. We historically have stayed away from big boxes. We thought, and I still believe, that the big boxes are potentially the biggest challenge to real estate ownership. There is very little depth left in most of the categories with these various category killer boxes. We had no circuit cities in our portfolio. We were lucky in that respect, and therefore Best Buys is really the only player, although H.L. Gregg has come into the market, taken a lot of the Circuit City stores. But the point is that there's very little depth. If you lose a Circuit City and you have to negotiate with the Best Buys, you're in a terrible position because they're going to tell you what the rent will be that they'll pay. It's not a landlord's world out there at the moment, and you really have very little clout in negotiating with a Walmart, a Target, a Home Depot, a Lowe's, etc., and even Best Buys, and all the way down to the lower size boxes like Staples. So we have historically stayed away from that product, but the market wants it. The market likes the big boxes. They like the co-anchors. And in fact, in our portfolio now, we have approximately 98% occupancy for the big box tenancies, whereas for the smaller boxes, we're at the low 80s. And even that's very good. But again, the market likes that big box property. They like added value plays. Even though they don't like floating rate debt and they don't like construction projects, they do like added value. In our case, we had a monstrous success with a property in Camp Hill, where we demalled a property, turned the stores inside out, filled a Montgomery ward with a large supersized Giant, etc. They like that, but they don't really want to pay for it until it's done. So you get very few people participating with the redevelopment, though they like the story of redevelopment. Take a company like ours, which has been more highly levered than a lot of the other companies that are most favored in the business. And I think it's true of most of the smaller REITs, in part because your leverage ratio to your total capital value is going to be a function of your stock price. Well, there's been this separation between large REITs and small REITs, between highly levered REITs and low levered REITs, favoring the larger companies and the lower level REITs, and therefore the burden on a smaller REIT like ours is to keep delevering. How do you delever? You can issue stock. The market doesn't want you to issue stock because you dilute the shareholders, or they don't want you to issue stock when your stock price is relatively low. The second thing you can do is sell properties, or, as in our case, joint venture some properties and raise considerable money, drive your debt down, boost your ratios, etc. It used to be that the market would look at the percentage of debt to total capitalization value. In our case, we drove that down from 64 to 56%. Again, at a time when our stock went down, they want less than 50%, and by joint venture creation, you can do that. In our case, we entered into the RioCan joint venture, which was transformative for our company, and it raised for us $115 million or so, which we used to drive down our debt and create greater availability under our credit facility. Dispositions of entire low end of the portfolio is what the market wants you to do. They want you to take that bottom 10 or 25% of your portfolio, especially the higher leverage properties, the properties that are in secondary markets, and dispose of them. So the market imposes all these disciplines on you that are very difficult to deal with, and sometimes, again, contrary to your thinking. The accounting concepts that play heavily on real estate investment should also be noted. For example, you're required to market for GAAP purposes any loan that's that carries an interest rate above market, so you have to mark that to market, and any lease that's either above or below market when you acquire a property. You're better off, paradoxically, for accounting purposes, to buy a property with a Kmart paying $1 a year for the next 50 years than you are buying a property with a full value, excellent Walmart, Target, whatever it is. Because you can take that $1, mark it to an $8 market rent, and multiply that times the 10 years remaining on the lease, and that adds to your FFO, which is one of the determinants of value for public companies or for public real estate companies. Correspondingly, if you're paying 8% on a loan in a market that's now, let's say, 5.5%, you're advantaged, and you can take a tremendous benefit to your FFO calculation again, because you mark that to market because you're going to replace it with debt at 5.5%. And these things are so contrary to what you'd normally like to do. You'd like to buy a property with a tenant that's paying good rent, and you'd like to buy it with a loan that's better than 5% if you can find it. Yet you're punished for these kind of things, and it's very difficult to match these real estate concepts with the public concepts. Those are some of the things that I wanted to touch on, and I'd love to take any questions that you might have. I'd be happy to talk about our joint venture arrangements with RioCan, which have been transformative for us and maybe of some instructive value to you all. RioCan is the largest REIT in Canada. It's a $10 billion company. They looked around for a U.S. platform. They didn't have any investments in the U.S. They picked us after talking to some other people, in part because they thought we could acquire, and we have been acquiring, but also in part because they thought we were on top of our game. We manage our properties, we think, very well. And they committed to 14% of our stock and 80% of 7 properties we owned at the time. We have now, during the past year, bought 14 additional properties with RioCan, spending at gross purchase price $345 million last year for acquisitions. We think these are very good properties, but are they the properties we would have bought ourselves? Maybe not. Maybe not, because what they like and what the market likes is stable, new stuff, big boxes, no vacancies, a lot of credit, long leases. Well, that's not where growth is. And the market wants growth, but at the same time, they want these beautiful properties. So again, you have this tension between what the market wants and what is good real estate. With the RioCan properties, the benefit for us is that we get a lot of fees. We get acquisition fees, we get financing fees, we get property management, we get leasing to the extent there's any leasing left, we get construction management, we even get an accounting fee for the extra reporting for the joint venture, but you pay a price for the joint venture. We are 20% owners, we're doing 100% of the work. On any given day, we've probably got 20 people working for our RioCan joint venture because their reporting is different from our reporting. They're under a different reporting system than our GAAP, and they're public, so they need a lot of information, a lot of reporting. And all of this is the kind of thing that when you're running a company, you have to try to balance, again, real estate versus public markets versus perceptions versus partners. And you have to work this out in some manner. We have been able to acquire for RioCan based on, I think, a history. And it's very important to note that this is still a people's business. In terms of sourcing properties, in terms of closing on acquisitions, it's very important that you establish a reputation for fair dealing. I think we've done that over the past 25, 30 years. Fair dealing is a very important hallmark. We bought we bought 5 properties from the Pennsylvania REIT. It was based on a telephone call from me to Ron Rubin asking if he had some properties available. We did that deal without a piece of paper until we closed. That's really nice, and it's very important. And I think we have been able to source properties also because you make the brokers look good. Brokers don't want to deal with retrading. So it's very important to make that broker look good to the seller. If a broker is going to recommend to a seller that you do an off-market deal, you better be damn well positioned to close on that property, to do your due diligence quickly and effectively, not to retrade, and to be true to your word, and above all, not to lawyer the thing to death. But I think those things are very important in our business, and we've been able to source properties, I think, in large part because we've been able to develop that reputation in the business. And I think it's very, very useful to us and will continue to be useful to RioCan. Our joint venture with RioCan is limited to properties in a 7-state area with 50,000 feet or more and or a grocer anchor, and it's for a 2-year mutually exclusive arrangement. It's not funded, so that we said that we would try to buy $500 million worth of properties over 2 years. It's a target. It's not a legal requirement. And during that period, we can't buy anything in this 7-state Northeast area, and they can't either without offering it to the other party. After 3 years, we can disengage through a buy-sell mechanism, which is in most joint venture properties. But in fact, they're very rarely exercised according to their terms. They're usually negotiated when one of the parties wants to get out. The joint venture runs for 2 years. It goes till October of this year, at which point, who knows what will happen. They could desire to extend it. They could buy us if they wanted to in a heartbeat. They might go national and do things with other people in other areas. But for us, that joint venture saved us at a time when we were very, very tight under our credit facilities. And because they're so well known in Canada, a credit facility that we had trouble extending, suddenly all the Canadian banks were just dying to get in our credit facility when RioCan came in. Let me leave it at that for the moment. Oh, and let me just mention one final thing in terms of the future and where we would go at this point. I think there's one thing that we can benefit from if we're careful about it, and that is that there is a tremendous separation at the moment between private developers and public real estate owners. I can call Merrill Lynch tonight and tomorrow morning have $50 million in our bank account. That's crazy. And of course we'll dilute our shareholders by doing that, but being public, you can do that. A private guy can't. We are completely transparent. We publish tremendous amount of information on our portfolio in our supplementary financial filings, and a private guy doesn't have that. You can check every loan on every one of our properties, what we paid for it, what the principal tenants are, what the terms are of the principal tenancies. A private guy doesn't have that. The other thing is that the loan structure for development properties these days requires that the developer put up 30% of the total project cost, get fully entitled beforehand, have pre-leasing to the extent that debt service is fully covered, all before you can get your first dollar on a loan. Well, there are very few private guys that can do that. And our opportunity is to partner up with some of these very excellent private developers who've created beautiful portfolios, but can't fund by themselves the 8 or 10 properties that they're working on. And that for us is a great opportunity, and we've had that model with several folks here, including the Fameco Group, with whom we've done a couple of wonderful properties, and we're working on some others. And we think that's a very good model for us going forward, because there you can add value. The problem is that the tenant leases, again, because of the dominance of the major tenants, you're going to be hard-pressed to show a historic 11 to 14% return on a development deal. Maybe you're at 9 to 11 if you're lucky. And then the highway department comes along and makes you build a 5-mile road, and that destroys your economics completely. So I do think that that's one area that we and others should be looking at, because it is a terrific opportunity, and that is an added value play. Even though construction isn't so favored by the investment community, they do like the new stuff, and they will fund, of course, when you reach stabilization or near it. The other thing that's troubling us in this market and will affect our ability to acquire is interest rates are going up. We were able during the past year to fund most of our acquisitions at 5% or even less for 10-year money. That's gone. It's 5.5 to 6 at the moment, with more severe covenants, and it is CMBS product again, which wasn't available for a while, but it's more expensive. And meanwhile, there's been cap rate compression for good properties. You've seen people buy at 6 caps or less at the moment. Well, you can't make it work, or we can't, if you're buying at 6 and borrowing at 5 3/4. We made it work last year because every one of our acquisitions was in the range of a 7.5 to 7 3/4 cap rate, and we were able to put the 5% debt on it. So that leverage plus our fees worked. But going forward, I'm not sure that that model will be available to us. Anyway, that's sort of our story. Yes, sir.
Could you go back to that mark-to-market for a few moments? I'm somewhat familiar with it as it affects the banking community. Actually, it's the first time that I've heard of it in terms of from a real estate investment standpoint. And how, I guess, are you saying if you buy the shopping center with a Kmart at $1 a square foot, that you immediately have to carry that on your books as if that rent was the market rent?
Well, for FFO purposes, funds from operations, which is one of the principal means of valuing public real estate companies, you take that dollar rent and you mark it to market by taking that full value as if it were leased at market and it had the same term, and you add that to your FFO. So suddenly you get this fictitious pop in your FFO that's GAAP but not cash, and it makes no sense. Correspondingly, very simply, all leases are straight-lined for GAAP purposes. So if you start with a lease at $5 and you have a 15-year lease and it bumps to 10 and 15, you're booking income, fictitious GAAP income, at $10 a foot, even though you're collecting $5. It's those kind of things that are just contrary to real estate sense.
And it makes the REIT look more favorable to the investor.
It does. It does. And what happens with REITs, and it's a sad story, the analysts out there, and we're covered by 6 or 7, they don't know anything. And they're not paid very well anymore because it's not a profit center anymore for the investment banks. And so they will accept whatever you throw at them. And the problem is that you have to get really granular to understand a REIT. Take the most simple concept, occupancy. Well, the REITs are all over the place. We basically define our occupancy based on tenants in place and paying rent. Other REITs do it on the basis of signed leases. Others do it on signed leases, tenants in place, even if not paying rent. So you have this tremendous disparity, which could be several percentage points. It could be 2-3 percentage points based on how you determine occupancy. Well, nobody gets that granular to get into how exactly they determine this, et cetera, et cetera. Yes, sir.
First, I want to say thanks for coming this morning. I wanted to get your take on the technological advances that are happening with the internet that you touched on in the Walmart effect, and how you think that will impact the operations of, say, the leasing function within a REIT going forward.
Okay, I'm not sure that I know the answer to that, but I think we just have to be extremely vigilant and see what's happening. I mean, we have in our portfolio, as does everybody, some blockbusters and Hollywood videos historically. Well, you can deal with those because those are usually 5,000 feet at an end cap somewhere, and you can replace them somehow. But a Barnes & Noble or a Borders of 25,000-30,000 feet, that's pretty hard to replace. And yet the function that we have to do is to predict all of this, which isn't so easy, and you have to just stay close to your tenants and see what's happening out there. But as I mentioned, I worry now about the electronics a lot. And will a Radio Shack survive? We have a lot of Radio Shacks. Everybody has Radio Shacks. They're great. But, you know, they're selling phones in their stores, which these card phones are a very important part of their business. And they're competing with your little Verizon store down the strip somewhere. Which is going to survive? And who knows? So it's that kind of stuff. And I think the internet has caused some of these electronic stores to start crimping their size. I think the Best Buys and the others out there have been shrinking their size. I think the H.L. Greggs coming into the circuit cities are usually smaller and won't pay a lot of rent to boot. And Staples, how much of Staples sales are related to their electronic products? I don't know the answer to that, but it's meaningful if you go into a Staples. And Staples has been downsizing a lot of their stores, creating these little convenience stores. So I see it as a very worrisome trend. And the one thing you don't want to do as a landlord is rely too much on fashion, because it's so serendipitous. I mean, one day Gap is the hottest thing in the world, and the next day they're practically insolvent because fashions change. And some people sell better denims than others. So you can't rely that much on fashion. Yet we all do to a large extent. We love TJ Maxx, we love Marshalls, because they're going to be there, and Ross Dress for Less, say, because they're working with a different demographic. But do you go crazy to put in a Ferragamo store somewhere with a beautiful front? Who knows where they'll be in a year or two. So I think the internet plays a huge role, and it will play more of a role. You see that Walmart sales are down dramatically in the U.S. Is that an internet factor? I don't know. But it plays.
You think it will downsize the entire industry in terms of the amount of people that operate within our retail real estate industry?
You know, it may be that we get much more to having the bricks and mortar available for people to pick up stuff that they order on the internet, which is what's happening with a lot of these stores. The other thing I'm a little worried about is within our sector with the grocery stores. The grocery stores have been transformed because of Wegmans and Whole Foods and Trader Joe's, for example. Those have had tremendous effects on the grocers. So you go into a grocer now, it doesn't look anything like grocers used to look. They have a bank inside, they have dry cleaning, they have babysitting, they have Wi-Fi rooms, they have cold rooms where you keep your groceries while you shop somewhere else and come in with a valet and pick up your groceries. I mean, they're just total. They have pizza ovens, they have bakeries, they have Chinese takeout, everything within a grocery store. And what are you left with when you have a tough grocer like Giant that wants to protect its franchise? all you can do is put in a nail salon. And who knows what the credit is behind the nail salon. So it's a difficult business, and it's a changing business. And I think we have to be just very vigilant. Yes, sir.
You mentioned you're heavily vested in Harrisburg, and you know they've already defaulted on their bonds. It doesn't look like there's any way out with that bad incinerator deal that they issued the bonds on. The mayor seems to be incompetent. It seems like the only out for Harrisburg as a city is bankruptcy. So what happens long term? It's the state capital of Pennsylvania. What happens if Harrisburg goes bankrupt?
I don't think that much would happen, to tell you the honest truth, and it may be the best solution, ultimately. Harrisburg, again, it's a small city, and unless something dramatic happens, and the state saved them for a couple of payments, but they can't pay this debt. And I think they have to declare, and other cities have done it. Even my county, Nassau County in Long Island, the richest county in New York State, the third richest in the country, has now been taken over by FINRA. Why? Because the costs of police pensions and everything else is so high that they can't really survive. And I think this is true now throughout the country. So I don't think it's worse for Harrisburg than anywhere, and I don't think the bankruptcy would be so bad because functionally they're bankrupt. And the thing that gives us encouragement is the fact that we're not in Harrisburg. We don't have one store in Harrisburg proper, but we love the area still. But again, I'll give you a concrete example. When we went out and tried to market 8 properties in Pennsylvania that were in a joint venture with a Canadian-Dutch group called Humber. For us, it was a very good joint venture. We had a promote structure in it. It cash flowed beautifully. 7 of the 8 were anchored by Giant, performing very well, huge sales, good rents, quite new product. Is Peter Miller here? I saw Peter earlier. At any rate, we bought them from him and the Caldwell Group. They were beautiful stuff. But you go to Met, Prudential, New York Life, Northwest Mutual. They don't want to invest in that kind of property. They want demographics. They want Washington, Boston, New York, Philadelphia. Main line, maybe you could sneak by, with Bryn Mawr and Radnor and Ardmore and whatever. But they want demographics. Yes, sir.
How are you handling the request by small boxes for concessions and fit out? It's pretty expensive to get in, a national tenant. You haven't met Dana Walker at our company. How do we handle it? This sounds crazy, but from Harrisburg East, we have had almost no problems with small tenants, believe it or not. The first thing we do, if they ask for relief, we give them a questionnaire. I learned this from Kimco. We give them a questionnaire. It's about 100 pages. It's so scary that they stop asking. The other thing we do, and I think it's important, you have to underwrite well when you put these people in. You have to get their financials, find out about their business. And the third thing that has helped us tremendously is if you have the dominant grocer in a market, that's where the little guys want to be. And they'll move out of their house into the store before they'll give up the store. So our total bad debt experience, other than our Ohio properties, I don't want to talk about those, but our total bad debt experience is less than 1%. And that's the little guys. You do get, Barnes & Noble came to us, to Nancy Mazzacchio,
leasing vice president, who is just damn good at what she does, and Lauren, the whole group. Barnes & Noble came to us, asked, we have a very nice store of theirs in Camp Hill. It's our only Barnes & Noble, thank God. And they asked for a 1-year extension and a reduction in rent by, let's say, 20%. The lease called for a 5-year renewal at 30%, 35%. Nancy hung tough, and they signed. So, you have to just find out how your tenants are doing, in fact, because you get programmatic requests for reduction. All the big boys asked for reduction 2 years ago, and we gave almost nothing. We gave it only primarily to a couple of fashion bug stores, for which we got something in return, and we gave it to Peebles. Peebles has been a difficult tenant for us in terms of generating enough sales to pay the rent. They're in secondary markets. They're sort of a mini full department store, and we gave them some programmatic relief. But we don't. We usually just defer, and our experience is that the best thing that we could do is after 60 days put them on notice, and after 90 days go to legal, because you'll never get that rent back on the small guys. Yes, sir.
Leo, for small to mid cap REITs, public ownership is the one that most operating generally have real estate, or are there other
Well, I think the REIT model is still a terrific vehicle. I mean, it permits people to buy real estate without going through title insurance and lawyers and everything else, and to get out. And the biggest challenge for the small cap REITs like ours is the large investors, the Franklins, Vanguards, Fidelities, who want to know how can they get out if they come into our stock. And that's a difficult answer because we're small caps. So there is this distinction between the large caps and the small caps for the major investors. But I still think it's a terrific vehicle. The worst part of it is having a board of directors, but we won't talk about that. Yes, sir.
Compared to the last 40 years, 1970, Wells Fargo, the double-digit inflation in the 80s, dot-com collapse is now. Is now the worst you've seen in 40 years?
No, I think 2 years ago was the worst that I'd ever seen. Worse than 90 and other years. The difference these days that wasn't available 20 years ago is that there's cash everywhere. There are mountains of cash waiting to be invested in real estate, and they can't find it. But there's never been a problem. Banks had money. Even though the CMBS market was destroyed, there was always money. Whereas, in 90 or 89 or whatever, you were paying 20% interest. So I think it's been worse because the public markets got pummeled so much 2 years ago. But I don't think it's that bad in general. Yes, sir.
What's your outlook on the mark-to-market for lease accounting?
I don't think it's going to happen. It's been deferred again for a year, and it's so fundamentally destructive to a lot of retailers that I just don't see it happening. Yes, sir.
Do you see an opportunity or an increased interest from your tenants on energy and energy efficient construction and solar and things like that?
Yes. There's very much attention to being green, and people come to us and want to put sod on our roofs everywhere, and that hasn't been a good model for us, especially with our roofs. And, you know, we've been sensitive to it in terms of wastewater management. That's been a key thing for our kind of smaller properties. The other thing is we are just installing solar roof panels on a Boscov store in Egg Harbor Township. Other than that, we haven't done much. But it is very au courant at this moment. Yes, sir.
You were talking earlier about how the markets like the big box tenants and they want more of that power center type of thing where it's big box tenants. However, like in the case of Circuit City, when they go out,
There's no depth.
yeah, you're
Well, that's our problem. If Barnes & Noble closes, what do? You wind up having an empty box for a while. Do you carve it up? If you carve it up, it's usually too deep, so you can't rent the back part. It costs you a lot to split it up. You have to put in new HVAC, everything else, and you're not going to get the rents. So it's really a challenge.
But why is the market looking at that model really hard, knowing full well that you could have another scenario like a Circuit City or a Hooters or someone of that caliber?
Stephen Barry's,
That
Mervin's.
go out. We can go on and name them all, but it would sound better to go more with the model you've been following.
Yeah, but
versus-
it's all about credit. And those guys have credit, and the little guys don't.
Until they fold.
Yeah. No, it's true. I mean, you're exactly right on. Yes, ma'am.
I just wanted to ask you about potential international expansion and what you saw as opportunities for globally, whether heading into China, India, Brazil.
I mean, for our company, we're not even out of Pennsylvania. Well, a lot of, the DDRs have gone to Brazil, and Kimco has gone to Mexico with a complete disaster, and they've gone to Canada with a monstrous success, and they've gone to Puerto Rico with great success. Others have gone to Europe and have failed trying to put stuff in Poland and stuff. We figure the only country that hasn't been really looked at, and Walmart obviously is selling monkey brains in China, which impresses me tremendously. We haven't looked at anything along those lines. I mean, the only country that might appeal to us would be either Bhutan or Mongolia, I think, because they haven't been explored yet by the West. But I just, no, for us, I speak read-write Dutch. I'd love to go to Holland, but a supermarket in Holland is 3,000 feet on a corner somewhere. I mean, it's just a different kind of thing. Well, John David, so
Chairman Bernanke 2 weeks ago whispered the word inflation and then quickly left Washington to go overseas. What are your thoughts on the I word?
I think inflation is coming, period. You see it already with the rents. You see it with interest costs. You see it with Chinese products. And appreciate that Walmart's 50% of its sales come from Chinese products. The dollar stores, it's 90% for Dollar Tree and Dollar Value and Dollar General. So that's going to hit significantly and have an impact on our tenancies, especially, I think, long run the dollar stores, which are among our very best tenants at this moment.
Okay, I think we're going to wrap it up.